Hello everyone and welcome to my next NAP. NAP stands for Nonprofit Auditor Points and I'm Irina Ryzhkova, your nonprofit auditor. I designed these NAPs to help nonprofit to understand better GAAP and accounting standard. Hopefully you will find these NAPs useful. And we continue the series regarding revenue recognition. In the previous episodes, we were talking about two different standards that govern revenue recognition for nonprofits, which makes revenue recognition quite complicated and sometimes confusing. One first standard is exchange transactions under 606, when nonprofit exchange services versus cash and donor or customer receives service or goods in exchange for about the same value. The second type of revenue is governed by 958, and that's revenue recognition for contributions. And we use general term contribution that includes gifts, bequests, donations, pledges, promises, grants. They all under terms contributions. And we recognize revenue as contribution when it's unconditionally promised. Very critical two words, unconditionally promised. We discuss what means promise, that means commitment, and it's not just intent. We also discuss what unconditional means and what creates a condition that needs to be barrier and right of return the funds. And we also discuss that multi-year contributions, regardless if they are promised for over long period of time, needs to be recognized for the full amount immediately if they are unconditionally promised. Then we talked about if you do have unconditional promise, it can come in two types, with donor restrictions and without donor restrictions. Donor restrictions do not affect revenue recognition, they simply affect classification of the revenue. And then we talked what kind of restrictions can be, time restriction or purpose. And if the restriction is satisfied when we release the funds, we do not record revenue anymore. Revenue was recorded the first time and the only time. When the funds are released, we simply record reclassification entry on the balance sheet. We decrease in net assets with donor restrictions and increase in net assets without donor restrictions. And today we're going to talk about something that relevant almost for every nonprofit, and it's one of the most overlooked topics of recognition revenue, and specifically it is in-kind contributions. Why we call them in-kind? First of all, because it's non-cash donations. Donation that comes not in a cash form calls in-kind donation, but it's still a donation or contribution. And we need to remember that contributions recognizes revenue under standard 958. So when they unconditionally promised. So what type of in-kind donations or contributions we can see? We can see donated professional services, we can see donated goods, donated rents, donated equipment. Some organization might record too much in kind. Some organizations record too little, or they don't record at all. So let's start with the big question. What is in-kind contribution? In-kind contribution is donated, as I mentioned before. It's something that is received but not in a cash form. But here's the key distinction. Not every donated service or item is recognized in the financial statement as in-kind revenue. Not every in-kind donation, not every donated service or item will be recognized. Under GAAP, General Accepted Accounting Principle, in-kind contributions, again, recognized, again, under the same standard for contributions, which is 958. And they need to meet specific criteria for revenue recognition. Okay, so let's talk about donated goods. And it should be pretty straightforward. If somebody donated computer, furniture, food, inventory, supplies, equipment, any tangible asset, and the organization received the full control over those assets, the contribution should be recorded at fair market value at the date of donation. It should not be any other valuation. It's not what the donor telling you to record. It's not what cost basis for the donor was. Maybe the item was inherited by the donor. Maybe donor purchased that item 20 years ago. Maybe donor received that item as a gift. For nonprofit, it's irrelevant. Nonprofit recognize value of goods at fair market value of the date of donation. So if someone donates equipment that otherwise needs to be purchased by the organization, and the value of that would be about $20,000, that's considered fair market value. And the nonprofits needs to record debit asset equipment, which is fixed asset, and credit revenue, contribution revenue at the date of donation. If the asset is start to be used right away, then we will record depreciation expense as well. Now, let's take a look at the donated service. Donated services can be a little bit more complicated because under GAAP, not every donated service is recognized. Only service is recognized as revenue if it meets two criteria. It's the professional service that provided by qualified person that operates in that profession, or the service that improves or enhances a non-financial asset. For example, volunteer that help build a playground. That's it. And volunteer does not need to be professional builder or professional professional construction service. Maybe he or she or they do not build typical stuff, but when he is building playground, he is enhancing improving capital asset, playground, and that's improving capital asset. That's considered services that should be recognized as revenue. It's recognized as revenue. And another example, when the service is provided by professionals that use professional skills, and that profession should possess those skills and typically otherwise the services needs to be purchased by the organization. And for example, that would be like licensed attorney that provide legal services, or CPA that provides tax filing services, or it could be a nurse that helps with in her professional capacity to run a program, or maybe fundraising consultant that helps nonprofit to draft a grant agreement. Those services are recognized at fair market value when they were donated. Now, here's what is not recognized: general volunteers' time. So when volunteers greet guests in event, help setting up tables, buying balloons, providing various administrative tasks, registering donors. All these services, they are neither professional or they don't enhance non-financial asset. They simply consider volunteer services, and they do not assess at fair market value. They do not recognize as revenue. So some nonprofits could be significantly supported by volunteers, but there is no value recognized for that time. So the gap does not allow to record general volunteer hours as revenue and expense. Now let's talk about donated rent or donated office space rent. If landlord allows your organization to use office, some type of office space or other space, maybe for fundraising event, free, rent free, and you have control of that space for that defined period of time, that's qualify for in-kind contribution. And you need to calculate fair market value of that time, and otherwise that if you need to purchase or pay for that rent, how much that would be. And you do need to recognize contribution revenue, debit rent expense, and credit contribution revenue at fair market value. Even though revenue and expense will offset each other, but they have to appear on financial statements like in-kind contribution and rent expense. Sometimes landlord will not provide rent-free facility, but below fair market value rate. Sometimes landlord will allow to rent premises at the value that below fair market value. You might have heard that some landlord have a specific rate for nonprofits. If this exists, it means that nonprofit still receives portion of the rent as in kind. And that portion that was discounted specifically for nonprofits needs to be recognized as in-kind rent. If your organizations receive substantial donated services or goods, your revenue and expenses may appear higher. So you need to remember to record in-kind revenue that under standards has to be recorded as revenue and expenses. So it might affect your program ratios, fundraising ratios, overall revenue. Again, the only difference that between in-kind contributions and regular contribution is that it's done in a different form. It's not in the form of cash, but first it's in the form of service, goods, but eventually nonprofit will need to turn the cash around and purchase those goods or services. So in-kind revenue as important for revenue recognition as cash revenue. There's some confusion about in-kind services when you compare your financial statements within 990s, because there are certain donated services are not presented on the Form 990 because under the IRS rules, they are not recognized on your Form 990. Therefore, please refer to my series about 990 presentation where I did discuss that topic in details, but you will see that some in-kind services will not appear in your Form 990. So just to summarize, very important to remember that in-kind revenue is always assessed and recorded on financial statements at fair market value. What it means that if you will need to purchase this services or kind right now, how much you will pay for these services. Sometimes it's required judgment. Sometimes it's required to see quotes from the other firms, similar firms, do some research on time online, or overall do some research to see what would be fair market value in order to assess the proper amount for in-kind services or goods. And for the audit trail, it's highly recommended to preserve that research, to preserve your estimate and assessment how your nonprofit came up with fair market value. And that support should include how was the value determined, was it reasonable, and what other support information is available. For in-kind revenue, GAAP requires nonprofit to disclose on financials information about in-kind. Specifically, it requires to present the nature of contribution, goods, services, what kind of goods, what kind of services, how they were used in the program, admin or fundraising, where they were used, any donor imposed restrictions, because sometimes donor can give in-kind donations like equipment or land or building, but it needs to be restricted for use. So you can only, for example, run program activity, you cannot resell the building. And any valuation technique, what valuations were used to assess fair market value of in-kind. And let's summarize and conclude. In-kind contributions are non-cash donations contributions, and donated goods are usually recorded at fair market value at the moment when they were donated. Donated services are recorded only in two instances: if the service enhances or improves non-financial asset, building playground, remodeling the office, making costumes for the performance, or require any specialized skills like medical professionals, attorneys, CPAs, architects. Those are professional services, and when the professional people provide services in their professional capacity. General volunteer time is not recognized as revenue, regardless who provides general volunteer time. It could be professionals, but if they do not provide professional services rather than admin tasks, those are just volunteers. And proper valuation and disclosure information is very important. In-kind accounting does require management estimate. It's not always going to be precise, so it's going to be management estimate. But fair market value will be estimated. It's management valuation, so do not try to be super precise, but you do need to support that information with the documentation, how the value was derived, based on what resources it was assessed, and how it was recorded. Thank you so much. Hopefully that was useful. Appreciate you being here with me here today, and looking forward to see you next time. Bye. Have a wonderful day.